So the Hang Seng, which is the index for the Hong Kong stock market, has dropped every single trading day so far in 2024. What a way to start the new year. This Chinese bear has been taunting investors for more than 3 years and counting. And fervent believers like myself are still paying the price for holding onto seemingly useless Chinese stocks with no end in sight. So I think the biggest insecurity most investors in the Chinese space have today is not so much about Chinese stocks not performing as expected, but more so the relative underperformance when compared to its investing peers. So comparison is a natural human condition. I understand. If everyone loses money together, like back in 2022, where we see the US market experiencing their bear market, it's fine. However, if everyone else seem to be making a killing in the market and you're the only one losing, I think that will have a sizable impact on your investing psychology and also your emotions. So you can literally compare Chinese stocks with any of its peers over a 5-year period. None of them comes close to destroying so much value. So I still remember vividly back in 2021, 2022, many people were essentially bashing ARK Invest and dragging Cathie Woods onto the streets, as the bucket of ARK ETF took a nosedive as we enter into an unprecedented rate hike cycle. But hey, take any Chinese equivalent index as comparison. The Hang Seng Index, the MSCI China, CSI 300, etc. etc. All of them underperformed the ARK Innovation ETF. By a wide margin, by the way, even though ARK-K is still nearly down 70% from its all-time highs. So I used to think that Cathie's way of investing is very risky for my liking. But if you were to take a snapshot of the last 5 years, many will actually come to the logical conclusion that maybe Chinese stocks are much more dangerous. So truth be told, as a fellow investor in the Chinese space, I have been asking myself the same question. Are we all wrong in our assessment? So is this the end of the Chinese stock market? They will never recover from here and everything is dead money? And you know what's the ironic thing? Alibaba's US dollar bond due this fall has outperformed the stock by 70% over the last 4 years. In 2023, even with the Federal Reserve hiking cycle, the bond beat the stock by 16%. What a world we are living in. You know what you can do? You can smash the like button and pinch yourself and you'll know that you're not dreaming. Backed by popular demand, Weibo has decided to extend their Money Bull campaign until the end of January. So they have since lowered their requirements for those of you who have yet to participate. Now, you just have to fulfill 2 key steps. First, tap on participate now and complete an initial funding of any amount during the campaign period, depending on the quantum that you wish to qualify. Second, subscribe to Money Bull and maintain the net cumulative deposit amount until the stipulated event period, and you'll be able to enjoy cash vouchers worth between 80 to 3,000 US dollars. So it has never been easier. So for those of you in Singapore who are afraid about the foreign exchange risks regarding conversion between the SGD to the USD, you don't have to. So there are no requirements regarding activating Money Bull on the USD or SGD terms. Either will actually do. So you just need to ensure that the accumulated deposit amount meets the requirement during the event period. So for those without a Weibo account today, I don't know what you are waiting for. Sign up with the link below now. Thank you Weibo for sponsoring this video. Interestingly, there was an article published by Bloomberg just last week with a very catchy title, and I quote, "Chinese stock indicator with 100% success rate is a flashing buy," unquote. Of course, as someone with a vested interest, I couldn't help but click into the article. Essentially, they are making the claim that the risk premium for Chinese stocks has reached a level that historically leads to spectacular returns. So there's so much pessimism that is being priced into the valuations of many of these Chinese stocks today that it might actually pay to be a contrarian. So what is this exclusive indicator, you might ask? It's basically the measurement of the difference in yield between the Chinese stock versus the Chinese bond market. So they're claiming that there has been 5 previous periods in almost 2 decades where the stock bond yield gap has reached 550 basis points, which is 5.5%. So the stocks rose in the following 12 months each time with a whopping return of 57% on average. So why is there this huge delta between the stock and bond yield? Simply put, most market participants are extremely pessimistic about the Chinese economy and by and large, the companies that are operating in this ecosystem. So fund flows are limited and companies' valuations across the board is not optimistic. So you have renowned Chinese tech companies, they are trading at PE ratios of 8 to 12 times. Financial companies like the major banks, major insurance corporations, they have price to book ratios of 0.3 to 0.7 times. And you also have major brands like Moutai, CATL, BYD, Li-Ning. They're all leaders in their own industry, from liquor to battery to EV to sportswear. They all took a substantial haircut in valuations as investors exit the market. So from their all-time highs, they're down at least 20 to some 60-70%. On the other hand, as investors become increasingly pessimistic, they would all tend to run to safety, and that's why more and more people are parking their monies with the bonds and fixed income instruments, driving the bonds prices up and the yields down due to purely demand and supply. So China's bond market has extended its rally, sending the 10-year notes to 2.5%, the lowest since April of 2020. So I guess the pessimism seeping into the financial markets of China today can kind of rival that of the pandemic 4 years ago. That's the stark contrast we are drawing today. So on that same note, some of Wall Street's biggest banks are actually betting on a substantial rebound for China's stock market in 2024. So strategists at JP Morgan have forecasted that the MSCI China Index will finish this year up roughly 18%, while Goldman Sachs has also set their 12-month target for the index at roughly the same level. So Elaine, the head of global asset allocation at Societe Generale, said that it's like waiting for Godot. We have had a tactical overweight on Chinese equities for a while, and it's been very, very painful. So I have two words, same bro. This significant underperformance is rising on the back of a record high outflow of money from the Chinese stock market and bad sentiments amongst Wall Street today. So foreign purchases of Chinese stocks dropped to an 8-year low in 2023. So I'll play a short clip from Bloomberg when investment director at Fidelity talked about her outlook for Chinese stocks in 2024.
I think it's going to be challenging. I don't think we're going to see a broad-based recovery. We've got a lot of elections. The macro data is still very, very mixed. I still think, I know I'm very alone in this space, but I still think China does look like it's an attractive market. I mean, a lot of people have discussed the challenges. The risks are so well known. Again, it's not going to be a broad-based recovery, but from a company-specific perspective, there are a number of opportunities. So, if you had to say which market is likely to outperform this year, I still think it's going to be Chinese equities.
Okay, on an index level, you think?
On an index level too, just because it is just so incredibly cheap. So unless the whole thesis around China is completely destroyed and void now, so many companies are trading at such cheap valuations.
The people that you speak with, I mean, cheap valuations has been a reality. We've been contending with anyway for the better part of the last 2 years. Do you get a sense that people are softening up? Foreign investors are softening up their stance on China, exposure to China?
It felt a little bit that in terms of sentiment was somewhat incrementally improving towards the end of last year, but the jury's out at the start of this year.
Okay.
So I think what's key for China is to continue to implement policy in terms of supporting measures, whether it's got to do with property, really being very transparent about any outstanding debt. But the companies that we're finding very attractive, I mean, they have pricing power, their earnings visibility is there. So even in this kind of challenging market where confidence is still a bit mixed, they're still doing well. And so if we do see a market recovery or an economic recovery, they'll continue to do well.
So all things considered, I think this comment from Liu of JP Morgan sums it well. And I quote, "While clients might prefer something concrete from Chinese policymakers to justify snapping up undervalued shares, but the best buying opportunity is when there are no catalysts," unquote. So after having said all these, what is the game plan moving forward? Do I trust this so-called magical indicator and expect that the Chinese market to rally 57% as claimed? Or will this just be another year where everyone gets excited about Chinese equities at the start of the year, like all your New Year resolutions, but we don't really see that big funds flowing in to support the share price. And Chinese stocks continue to underperform, and we just rinse and repeat this story again in 2025. So I think let's get something straight first. All of us, regardless of whether you are from a bulge bracket bank on Wall Street, investment directors and independent funds, client advisors, financial advisors, and even YouTubers that create videos like myself, we have our inherent biases. So for those of you who don't know yet, I'm a relatively big Chinese bull for quite some time now. So by default, you should already know that I'm bullish. So 2022 was not our year, 2023 didn't turn out too pretty either, and I'll probably still stay bullish in 2024, unless I change my opinion and position. And you'll see that change reflected in my portfolio as well. So at least for now, 70% of my positions are still in Chinese names. So you can kind of infer for yourself where I stand with Chinese stocks today. I don't intend to touch my Chinese names too much unless something major happens. Fundamentally, I still see immense value in many of the names that I currently own. And I'm pretty envious of those who only started taking action today with such a huge margin of safety due to the low entry prices. So I'm personally not accumulating more for now, purely from a portfolio allocation perspective. So for 2024 specifically, I do see several tailwinds around the Chinese story. First, I'm expecting corporate earnings to have bottomed out 2 quarters ago, and we'll see accelerated growth again in their numbers for this year. Second, I'm looking forward to the next 2 sessions in March, where the party leaders of the CCP will announce their growth targets and also their policy priorities for the year. So there have been a lot of commotions at the end of last year around proactive fiscal and effective monetary policy to essentially support economic growth. But many investors are not buying the story and are calling the bluff of the policymakers. So we'll keep our eyes peeled on more forceful and also targeted solutions at some of their internal challenges back in China today. And third, some of the names that I own, they have been stepping up on their buybacks at current valuations. And I hope to see more aggressive buying and dividend distribution, not so much because I need the money, but more so it is a signal that they're determined to benefit shareholders in the longer term. So I believe for many of you that are stuck back holding, you're faced with this same conundrum. On one hand, you see your friends printing so much money from the US market, from the crypto market, from the whatever market, and even those that bought bonds are much better off than you. On the other hand, the contrarian side of you thinks that this opportunity is hard to come by, and if you're to really sell out now, you might be selling at the bottom, while chasing the highs in another market. So I can't advise what you should do, but I think you should make the assessment on a portfolio level. Are you overweight? Are you underweight? Do you have too much allocation? Do you have too little allocation? Focus more on the overall exposure and allocation. And of course, perform all your what-if analysis and cost-benefit and risk-reward. So if they continue to underperform for 3 to 5 years, will we be okay? And many of the questions along those lines. So don't keep focusing on, oh, China is so cheap now, and everyone is saying that it will go up by double digits this year. So that's why I want to leverage and get maximum returns. And I think I can only say, keep calm, and I hope to finally see you on the moon in 2024. Goodbye.